HP, baby. Hey, I've been looking forward to these earnings from HP, and you know I have. So there's obviously a lot to talk about for this quarter as far as they are concerned. They just reported some earnings, and when you think about all the factors that go into everything, as far as earnings are concerned, a lot of work from home, a lot of back to school now as part of them, and with back to school being mostly digital, you see AP or HP probably see some demand increases, right? You'd think so. So I'm very interested. Obviously, I wanted to see what the demand looks like during these earnings because last quarter wasn't quite in full effect. This quarter was a full pandemic quarter, baby. And you see overall, these are some solid numbers. So HP post a non-GAAP EPS of 49 cents, which is a beats by 6 cents, and a GAAP EPS of 52 cents. Beats by 13 cents. So it is good to see a beat on that aspect. From a revenue perspective, you did see a 2.1% decrease year over year, but they did post a $1 billion beat, which is a massive beat, all things considered. So there are positives and there are negatives this quarter, no doubt. I can't lie to you. Looking from an EPS standpoint, you take that as a pretty good quarter for them. Nothing too crazy. Revenue, I mean, you don't like to see a decline, but you do enjoy a beat of that caliber. Operating margin of 6.1% versus 6% consensus. And fiscal year 20 GAAP EPS of $1.83 to $1.87 expected for the full year. And that's something, above consensus. If you look at the non-GAAP perspective, you do look at it's above the consensus. Okay, so there's positives to it, and obviously we look at this nonsense. We don't have the good stuff quite yet, but that's why we go straight into the beauty that is the earnings report. Give me the press release, baby. That's what we're talking about. So, overall, previously outlooked 35 to 41 cents per share for this quarter. They posted 52 cents. Hey, that's just all I'm trying to tell you is that's what I would call a beat. Third quarter net cash from operating activities of $1.7 billion and free cash flow of $1.6 billion is a nice number. I like to see that in terms of just bringing home the bacon because you gotta love seeing that. And quarter three returned $1.2 billion to shareholders from repurchases and dividends alike. So pretty nice from that aspect as well. I do like to look at a EPS comparison. This line right here. So overall, you saw a 33% decline in terms of EPS compared to last year, and it's not 100% unexpected either. So there's obviously, again, a lot of factors that go into this, and to see a decline in that aspect, I'm not incredibly shocked, but I would like to see better numbers. There's so many companies right now that are posting just awful EPS declines. This one's not horrific, all things considered. So as far as highlights are concerned, obviously, their president CEO, Enrique Lores, are strong quarter three results and solid beats for the quarter in the face of unprecedented uncertainty. Reflects the agility of our teams and strength of our portfolio. Don't know what's happened to his voice there, so we're going to say he's normal from now on. We're leveraging our leadership across consumer and commercial markets to capitalize on opportunities from the essential role of the PC in the era of remote work and school to the rise of subscription-based business models to enable greater flexibility. That's what it's all about. As far as by segment, we see overall personal systems saw net revenue show a 7% increase year over year. Personal systems, what are you shocked about that? You love to see it. Obviously, Good stuff. But commercial net revenue decreased 6%. Not good to see on that aspect. From a commercial standpoint, you don't like seeing that. You want to see some better stuff. But consumer net revenue increased 42%. So again, the businesses are losing a little bit out in terms of HP. Not a shocker. A lot of businesses clearly are not doing a lot of reinvestment in themselves, especially smaller businesses, because, well, hard to do it right now. They've got a lot of stuff going against them. Total units were up 11% for notebooks and 32%. Total units up 11%. Notebooks up 32%, and desktops down 30%. So notebooks obviously being their laptop sector. Not an overall big shocker. Again, laptops are big for back to school, and that's kind of the focus right now. Desktops are more of a consumer, or I should say a commercial item that are typically used. And since they weren't selling quite as much in terms of commercial, laptops were taking over. So laptops taking over, doing the dirty work. That's how it is. As far as the outlook is concerned, for the fourth quarter, they're expecting 32 cents to 36 cents. Not beautiful as far as that gap EPS is concerned, but, could be a lot worse. So, yeah, nothing super concerning. They don't actually give me a estimate in terms of revenue, so that's one thing to look at. But, not too shocked about that. I do want to look at the balance sheet, obviously. Seeing that free cash flow, $1.6 billion, gets me a little bit, might need to loosen the belt buckle. So, you want to see what happens to the balance sheet. And this is key stuff right now, because a lot of companies are flooding cash to their balance sheet, and it's not good for them. It's not good. Not good. Total current assets of $20.2 billion. They do give me the loveliness of a 9 months comparison. I do like a 9 months. I prefer a 1 year, but I do like a 9 months comparison too. It's better than a 6 months. It's better than a 3 months. That's all I'm telling you. So $20.2 billion compares to $20.1 billion of 9 months ago. So not much movement there, but it is good to see positive growth there. Total assets in general of 34.2 versus 33.4. Around $800 million increase in terms of total assets. Not an awful thing by any means, so I give them credit for that. Liabilities, I want to see a decline. Now, overall, total current liabilities of $25 billion versus $25.2 billion. Slight decline. We like to see that overall. We really do like to see that overall. But I will mention, obviously, the numbers aren't quite as beautiful as you might like to see. I want to see some better numbers. HP, because you see a stockholder deficit. Oh my gosh, it's actually risen. It has risen because you see an increase in long-term debt and other current or other non-current liabilities. So stockholder deficit of $1.9 billion, not beautiful. Nearly $2 billion versus really $1.2 billion. It's not a good thing you like to see. Overall balance sheet grew, but you did see that deficit mark increase as well, and I'm not a huge fan of that. No doubt, HP is a long-term pick for me, and there's definitely valid reasons for its very cheap valuation right now, and I can't deny it. It's a company that needs to do a lot of really reevaluating of the business, and I think that they will. So just give it a little bit of time. This is a long-term thing for me. I'm in for the long term. I'll suffer through the dismal share price in the meantime. Overall, dividends treat me well though, so I can't complain too much. So hope you enjoyed. I'm not saying necessarily this is the time to buy, but if it's under $17, I'm buying.